Hey everyone, welcome back to Corporate Decoder, the place where we decode the wild world of finance, and today we're diving deep into Crown PropTech Acquisition's latest report. Get ready because this one has some wild twists and turns, almost like a roller coaster trying to find its next big theme park attraction. So, what is the big story here? Crown PropTech is basically a company that pools money together to buy another company. Think of it like a treasure hunt for businesses, and this report is their map showing where they've been and what they found. We're going to break down their finances, see what is going on with their money, and figure out if this treasure hunt is leading them to riches or just a dead end. Let's kick things off by looking at their balance sheet, which is like a snapshot of everything the company owns and owes at a specific moment. On the 30th of September 2025, Crown PropTech had total assets of about $5.8 million. That sounds like a good chunk of change, right? But here is where it gets interesting. A huge part of those assets, about $5.7 million, is tied up in their investments held in trust account. This is literally money they've set aside to buy another company. It is not really money they can spend on day-to-day operations, it is earmarked for a deal. Now, on the flip side, their liabilities, which are the money they owe, are pretty high on the short term. They have about $5 million in accounts payable and accrued expenses and due to related parties. That is a lot of bills to pay. When you put it all together, the company has a shareholders deficit of almost $5 million. That means on paper, what they owe is more than what they own, not counting that money held in trust. This is a pretty common situation for companies like this, which are still in the process of finding a business to acquire. Now let's look at their income statement, which shows how much money they made and spent over a period of time. For the 3 months ending the 30th of September 2025, they reported a net loss of about $187,000. And for the 9 months of the year, that loss jumps up to over $2.1 million. Ouch. They're not bringing in any revenue from operations because they haven't bought a business yet. Most of their activity is just managing the money they raised and paying for the costs of being a public company and looking for a deal. They do have some trust dividend income, which is just interest earned on the money they've set aside, but it is not enough to cover their operating costs, which are around $2 million for the first 9 months of the year. This statement shows how the equity section of their balance sheet has changed. It is pretty much a story of ongoing losses. For the 9 months ending the 30th of September 2025, their accumulated deficit, which is just the running total of all their losses, grew to over $17 million. That is a big hole to climb out of. They also have a significant amount of Class A ordinary shares subject to possible redemption, which they classify as temporary equity. This means a large portion of their shareholder equity can be bought back by the company, depending on certain events. As of the 30th of September 2025, there were almost 500,000 of these shares valued at over $5.7 million. This statement tells us where the company's cash came from and where it went. For the 9 months ending the 30th of September 2025, their cash used in operating activities was nearly $500,000. This is mostly due to their net loss. Interestingly, they had about $250,000 provided by investing activities. This sounds good, but it is actually cash withdrawn from their trust account due to share redemptions, meaning people are asking for their money back. Their financing activities also show a bit of movement, with some money coming in from loans and sponsor contributions, but also money going out for redemptions. Their cash balance outside of the trust account is incredibly low, just $425 as of the 30th of September 2025. This highlights how dependent they are on the funds in the trust account. So, what exactly is Crown PropTech Acquisitions? It is a company formed in the Cayman Islands back in September 2020. Their whole purpose is to merge with or buy another business. Essentially a blank check company. They haven't started any real business operations yet, and they won't until they find a business to combine with. Their sponsors are Crown PropTech sponsor LLC and Sieg Management III. This is pretty standard for a special purpose acquisition company or SPAC. Here is a pretty big red flag. On the 12th of February 2024, the New York Stock Exchange decided to delist Crown PropTech shares. Why? Because they failed to complete a business combination within the required timeframe. This means their stock was removed from the NYSE. This is a serious development, indicating a significant hurdle in their path to acquiring another company or a potential failure to do so. This is a crucial piece of information. On the 2nd of July 2025, the company entered into a business combination agreement. This is the step where they found a target. They plan to merge with a company that will eventually be named Menkango Rare Earths Limited and is expected to trade on NASDAQ. This is their shot at finally completing their mission. The company has had several shareholder meetings to extend the deadline for completing a business combination. These extensions show they've been struggling to find and finalize a deal. In February 2024, shareholders approved an extension. Then again in August 2024, and most recently in May 2025. They got an extension until the 11th of March 2026, each time a significant number of shareholders chose to redeem their shares. For example, in August 2024, over 1.4 million shares were redeemed, pulling almost $16.5 million out of the trust account. This tells us that investors are getting nervous about the company's ability to find a successful business combination. This section is pretty sobering. As of the 30th of September 2025, they had barely any cash outside of their trust account, just $425. Their working capital deficit is nearly $5 million. They are heavily reliant on the funds in the trust account, which can only be used for a business combination or for redemptions. The report states that management has substantial doubt about the company's ability to continue as a going concern. This means they might not be able to stay in business for a full year without finding a way to get more money or complete their business combination. The deadline to do so is the 11th of March 2026. If they fail, they will liquidate and dissolve, and the shareholders will get back what is left in the trust account, which may not be much. This section explains the accounting rules they follow. Being an emerging growth company means they get some breaks on reporting rules, which is good for them, but can make comparing their financials to other companies a bit tricky. They're also taking advantage of a provision that lets them delay adopting new accounting standards, which again, can make comparisons harder and hints at a potential lack of resources to implement complex new rules quickly. This is where we see who is involved behind the scenes. The company has issued founder shares primarily to Crown PropTech sponsor and other affiliated entities. These shares have special lockup periods and restrictions. There are also working capital loans from related parties, which are essentially loans to keep the company afloat. As of the 30th of September 2025, they owed over $1.5 million to related parties. This shows a heavy reliance on insiders for funding, which can be a double-edged sword. It keeps them going, but also means their future is tied to their sponsors' willingness to keep injecting cash. This outlines future obligations. They've engaged a financial advisor, Jet Capital, for their proposed business combination. The fees for this advisor are substantial and are contingent upon the successful completion of the business combination. This highlights the significant costs associated with pursuing a deal. This is a critical disclosure. The CEO stated that their disclosure controls and procedures were not effective. Specifically, there is a material weakness in their internal control over financial reporting related to accounting for complex financial instruments and review procedures around key reconciliations like accruals and payables. This is a serious concern, suggesting potential errors in financial reporting. They acknowledge the weakness and plan to improve, but can't guarantee it will be effective. So, what is the takeaway from all of this? Crown PropTech Acquisitions is in a precarious position. They've identified a target for their business combination, which is a positive step. However, their financial situation is concerning, with a large accumulated deficit and very little cash outside of their trust account. The delisting from the NYSE is a major setback, and the material weakness in internal controls raises questions about the reliability of their financial reporting. While they are taking steps towards a business combination, the path forward is risky. Their ability to continue as a going concern is in doubt, and they have a hard deadline to get a deal done. Investors should pay close attention to the progress of the Mkango rare earths deal and whether the company can overcome its operational and financial challenges. For now, it looks like a high-risk, high-reward situation, with the odds leaning towards caution. Alright, that is our deep dive into Crown PropTech Acquisition's latest report. What do you think about their chances of pulling off this business combination? Let us know in the comments below if you found this breakdown helpful. Smash that like button and subscribe for more corporate deep dives. And don't forget to join our Discord community, linked in the description for more real-time discussions and insights. Thanks for watching, and we'll see you next time on Corporate Decoder.